Welcome to the Deep Dive from Talk Tickers. We take the most critical corporate announcements, the earnings calls, investor days, you name it, and we break them down to find the real story.
Exactly. And today, we're looking at a really interesting one. It's a classic contradiction. You've got a soft fourth quarter report, a huge write-down.
And the stock just soars, double digits.
It makes no sense on the surface. We're talking about Simulations Plus, ticker SLP. This is their fourth quarter and full fiscal year 2025 results call, which happened Monday, December 1st.
And for anyone who doesn't follow this space, what exactly is SLP's business?
They're a software company, fundamentally. Their niche is something called biosimulation.
Biosimulation. Okay, break that down for us.
It's basically using really advanced computer models to predict how a drug will act inside the human body.
So it's like running virtual experiments to save time and money on real ones.
You got it. It cuts out some of the most expensive, riskiest parts of drug development. So our mission today is to figure out what management said on that call that was powerful enough to make investors completely ignore the messy Q4 numbers.
Right. Find the signal in all that noise. So let's start with the noise. The Q4 results themselves.
Yeah, they were. Let's just say mixed. The top-line revenue came in at about $17.5 million.
Which was basically in line with what Wall Street expected, right?
It was, but, and this is the important part, that's a 6% decline compared to the same quarter last year.
Okay, so revenue is actually shrinking. What about profit?
Same story. Adjusted EPS was 10 cents, which was exactly what was expected, but that's down from 18 cents a year ago. A huge drop.
A drop like that? I mean, that usually pushes you into a loss, doesn't it?
It did. On a GAAP basis, they had a net loss of about $700,000 for the quarter. Management blamed it on, higher costs and just a tough spending environment in biopharma.
So on their own, those Q4 numbers sound like a recipe for a disaster, not a rally.
Absolutely, which is why you have to zoom out and look at the full fiscal year. That's the first clue.
Okay, so how did the full year look?
Much, much better. Full year revenue was actually up 13%, hit $79.2 million.
13% growth for the year. That's solid.
Very solid. And their adjusted EBITDA was $22 million, a 28% margin. And the big one, adjusted EPS for the year, was $1.03. That was an 8% jump, and it landed right at the high end of their own guidance.
Okay, now that makes more sense.
Yeah.
But we have to address the elephant in the room, the huge GAAP loss for the year.
The $64.7 million loss. Yeah.
Where did that come from if operations were pretty good?
It was almost entirely from a single non-cash charge. A massive $77.2 million impairment on acquired intangibles.
Let me guess. This has to do with the Proficiency acquisition.
100%. They basically had to admit that the synergies and cash flows they expected from that deal just weren't materializing. So they had to write down the value on their balance sheet.
It's like an accounting mea culpa. They take this huge one-time hit, clear the decks, and signal to the market that it's a clean slate going forward.
Exactly. And investors often love that because it removes uncertainty. But let's dig into the Q4 operational issues because it wasn't just accounting.
Right. The revenue decline, where did that come from?
It was pretty evenly split.
Yeah.
Software revenue dropped 9% and services revenue was down 3%.
Okay, the software side is the one that worries me. That's their core recurring business. And I saw something about the renewal rate.
Ah, yes. You're right to focus on that. The software renewal rate on an account basis, it slipped to 83%.
83. Wow. I mean, their target is usually what, over 90?
Over 90, yeah. That's their historical sweet spot. So an 83% rate, that immediately raises red flags.
So are customers leaving for competitors?
See, that's the critical distinction management made. They said, no, this is not about competitive losses.
So what is it then?
They blamed two things. First, client M&A, two companies merged and they only need one license. And second, something they called module rationalization.
Module rationalization?
Yeah.
That sounds like corporate jargon for budget cuts.
It is. It means a big pharma company is keeping their main SLP license, the one they need for regulatory filings, but they're cutting back on all the extra specialized add-on modules to save a little cash.
So they're trimming the fat, not canceling the subscription. The core relationship is still there.
Exactly. It signals budget pressure, not that the product is failing. And that budget pressure is coming from the wider macro environment.
Right. So what did management say was causing all this caution from their customers?
They described it as a sort of triple threat. You had slow biotech funding, some tariff worries, but the big one was regulatory uncertainty around drug pricing.
This would be the most favored nation stuff we heard about.
Precisely. The threat of the U.S. government forcing drug prices down to match lower international prices, it just paralyzes R&D budgets.
Because if you don't know what your profit margin will be on a new drug, you're not going to spend an extra dime developing it.
You're definitely not going to buy new software modules. You wait and see. So the low renewal rate is a symptom of that fear.
Okay, that makes sense. But amid all that caution, I saw one number that looked really strong. The backlog.
Yeah, that's the other side of the coin. The backlog of future work grew 28% year over year. It's up to about $18 million now.
And they expect most of that to turn into revenue soon.
They said at least 90% of it should convert in the next 12 months. So it shows that while clients are cautious right now, the underlying demand is still very strong.
And to get through this soft patch, management's also cutting their own costs, right? This unified operating model.
They are. They're trying to find about $4 million in annual savings. It's about efficiency, some headcount reductions. It gives them a nice margin cushion while they wait for growth to pick back up.
Okay, so that sets the stage for the real story here, the pivot. If growth is guided to be basically flat next year, why did the market get so excited about their talk on AI and the cloud?
That is the multi-million-dollar question. The market is betting that management is sandbagging the guidance because the long-term trend is it's undeniable.
I've heard.
It's this move from selling individual software tools to offering a whole integrated ecosystem. They're combining their simulation engines with cloud computing and, the big buzzword, AI-assisted workflows.
So what does AI actually do for a scientist using their software? What's the real-world benefit?
Speed. Massive speed. Management gave an example of running a complex simulation, like how a new drug interacts with other common medicines.
Okay.
Historically, that could take days of a computer just churning away. With AI and the cloud, they're aiming to get that down to minutes.
Days to minutes. Now that is a real value proposition. That saves an incredible amount of time in the R&D cycle.
And that's why they think they can charge more for it. That's the whole thesis. The first big product with this is GastroPlus X.2 or GPX.2 on their cloud platform.
And they see that as the template for the whole portfolio.
Yes. They're explicitly saying this AI integration will support more aggressive pricing and help them sell more products to existing customers.
But there's a catch, isn't there? They said customers are still in the early integration phase.
Right. So the spending on AI is happening now, but the revenue benefit, that's coming later. That's why the immediate guidance is so cautious.
Let's look at that guidance again, because that's really what moved the stock.
So they reaffirmed their full fiscal year 2026 guide. Total revenue between 79 and 82 million. That's basically flat to 4% growth.
Flat to 4%. That screams caution.
It does. And they were even more cautious about the next quarter, Q1. They expect revenue to be down 3 to 5% year over year. Part of that is seasonality, but they're clearly managing expectations down for the start of the year.
Okay, so let's put it all together. A soft Q4, a massive write-down, a weak renewal rate, and flat guidance. And the stock jumps 14%.
Yep.
Why? What was the one thing that drove that rally?
It was relief, pure and simple. The stock had been beaten down so badly, down 45% over the last year. Investors were terrified management was going to come out and slash guidance for 2026.
And when they just held it steady.
When they reaffirmed it, it was like a massive exhale. The market took it as a signal that the bottom is in. That flat guidance wasn't seen as a ceiling, it was seen as a solid floor.
A fear-based rally. Okay. But there are still some pretty big risks here that the market seems to be ignoring.
Oh, absolutely. That $77 million impairment is a big deal. And there's still an ongoing legal investigation into potential securities law violations. That's a headline risk that hasn't gone away.
So the whole investment case really boils down to one thing.
Can they execute? Can they turn all this great science and all this AI talk into a real scaled platform that people will pay more for?
And what's the next big data point for that?
January 21st, 2026, they're having a virtual investor day. That's when they have to provide the real details, the product roadmap, and crucially, how they plan to make money from AI.
They need to show a path to monetization. I also heard them hint at more M&A.
They did. Once this Proficiency mess is fully behind them, they said they'd be open to looking at deals again, probably starting later in fiscal 26.
All right, that brings us to our This Is Not Financial Advice segment. We've gone through the numbers, the narrative, the risks. let's pitch an outrageous but plausible trade idea based on this call.
Okay. The thesis is pretty straightforward. You go long the stock. The bet is that the $77 million write-down really did mark the bottom, and that the AI story is powerful enough to carry the stock higher, even with the weak macro environment.
And you want to take advantage of the fact that even after the rally, there's still a lot of fear baked into the stock price.
Right.
The implied volatility is still high.
It's still up around 67%. So the structure of the trade is you buy the stock, but you also sell an out-of-the-money put spread that expires just after that January investor day.
So you're using the market's own fear, that high volatility, to lower your cost of buying the stock.
Yeah.
You're betting the investor day will be a positive catalyst.
Right. You're betting that this recent 14% rally has set a new floor and the investor day will push it up from there.
Okay, so what's the outrageous part? What's the big risk you're choosing to ignore with this trade?
The outrage is that you're completely overlooking that 83% renewal rate. You're ignoring the operational friction in Q4, and you're ignoring the legal overhang.
You're making a pure bet on the future narrative.
You're betting that the AI story and the structural need for biosimulation are so strong that they will completely overshadow all the messy history and lead to a big re-rating of the stock in early 2026.
A fascinating setup. So let's wrap this up. What's the key takeaway for you, the listener?
I think SLP's story is really the story of the whole biotech software sector right now. You have this unstoppable structural demand. Biosimulation is becoming the backbone of R&D.
But it's fighting against these temporary headwinds from budgets and regulations.
And the company's entire future, at least for the next year, really hangs on one thing: translating their science into a product that commands higher prices because of AI.
Which leads me to the final provocative thought for everyone to chew on. You have management being very cautious on demand, but very aggressive on their AI pricing plans and cost savings.
Right.
So the question is, how quickly can that promised $4 million in savings and that new AI pricing actually start to cover up the budget pressure we're still seeing on renewal rates?
Yeah.
That gap, the gap between the AI talk and the actual monetization, that's everything to watch next year.
And that gap will be the difference between 4% growth and maybe, just maybe, something much higher.
Thanks for joining us for this deep dive. As always, remember to do your own research. Nothing you heard here should ever be taken as financial advice. We'll see you next time.